Hello and welcome to Switzer TV. I'm Peter Switzer. Thanks for joining us. And on tonight's program, we have Adam Dawes of Shaw and Partners, and we're talking about a range of companies that people have been asking me about on our Boom, Doom and Zoom show, which is for subscribers to the Switzer Report. We're looking at Megaport, we're looking at Kelsian, Lindsay Australia and Mineral Resources. And I throw a number of other companies at him without notice. And he's given us some very interesting buying opportunities, as well as a few companies that are worthy of being sold. And then I caught up with Rudi Filapek-Vandyck, the founder of FN Arena. And I asked him about whether we can trust this rally that we're on now. Will stocks eventually rebound and have a really good 2023? And we look at the companies that he really likes right now. Rudi is always worth listening to. And invariably, even though we don't always agree, he does provide some very interesting insights. That's the program. Let's now kick off with Adam Dawes of Shaw and Partners. Well, thanks for joining us, Adam.
Yes, it's great to be here, Peter. Thank you.
Isn't it great that the market is rebounding at the moment? A nice rally. I was interested to see, mate, that the NASDAQ is up 16% over the quarter, which a lot of people were surprised about. Can we trust this rally?
Yeah, it's a tough one, isn't it? Because as always, we climb the wall of worry, but then we're, pretty much it just it continues to go down on the downside if the market sentiment starts to turn. I think, this time around, it does look a little bit different. We are sort of looking at potentially interest rates starting to slow down a little bit. We'll see how we go on RBA tomorrow. But I think overall the Fed is looking and sort of having more of that pausing language, which is giving opportunity to markets to potentially then start to look at some other sectors that have been beaten down. And certainly tech is one of those ones where I think has definitely been overdone.
Yeah. I looked at a piece on CNBC in the week, and I don't know if you saw that, but they looked at about 10 or 12 stocks that have hit either 1 year or all-time highs. And 3 of them were in food or hospitality. I think Darden was one, Monster Beverages, which I guess, all those young people inexplicably drink. Yeah. They don't, but there was about 4 or 5 technology companies, and they tended to be high-end technologies, from Oracle to GE healthcare technologies. But you can see that they're starting to look at those profitable technology companies, and they're interested.
I think that's absolutely the key, Peter, is that profitable technology businesses. And at the moment in the Australian market, it's harder to find some really good profitable tech businesses that people can get behind. I mean, there's lots of stories out there, speculation or whatnot, of how great these companies are. But if you're not having got the revenue in the door, you don't have the earnings, then you get sin-binned and you get put aside for those ones that are profitable going forward. Now, if the market then starts to take off and there's a bull market and things like that, I think earnings goes out of the door a little bit, because then it's the possibility of revenue in 2024, 2025. But for a lot of these things, it is now coming down to, are you profitable? And then are you a buy or are you sell? But basically, profitable businesses are getting a little bit more love at the moment.
Okay. Well, that's interesting. It's a good starting point to a particular stock that you and I have talked about before. But I was actually intrigued to see Shaw and Partners on FN Arena's list. I haven't seen you guys there before. So obviously, they're loving, FN Arena's loving you like never before, but you might have been there, I just didn't see you. But Megaport was the one. I think you guys had a pretty big call on Megaport, and I've liked the company. I know it's disappointed, but the one thing I keep telling people is that don't think I'm recommending it. Every analyst on that sheet liked the company, and the range of share price rises are all very big, and you guys had a particularly big one. So I wanted to talk to you. What are your guys seeing in this company?
Yeah, certainly the share price reaction, I think, reflects the weakness in the key KPIs that Megaport's put out to the market, such as customer adds and ports and services. But is the sell-off overdone? I think, look, certainly the CEO's departure likely will result in a turnaround, but it's just going to take a little bit longer. And I think that's what the market's basically looking at, because we expect the third quarter to continue to be impacted by weak macro conditions. But then going on, I guess, forecasting that moving forward, that, you know, in 2024, we should really start to see that growth starting to go through, and Megaport being one of those ones that has very good, consistent growth going forward. Bevan Slattery is now coming in to the business to be the interim CEO, and uncertainty remains around that. So I think there's going to be a bit of a cloud around that until they can find somebody. But overall, I think medium term, the risks look elevated for some operational uncertainty, but longer term, I think this business actually looks really, really good. So it depends on what kind of investor you are. Are you one of those short-term sort of look, or do you look longer term? I think there'll be some more uneasy waters in the medium term, but longer term, I think Megaport is a fantastic business. And if tech does start to run, it will also run with that.
Okay, let's go to some companies that were asked of us by our subscribers to the Boom Doom Zoom show. Here's one I don't know much about, Kelsian, which is in the transport space. Do you guys have an opinion on Kelsian?
Yeah, look, it's very defensive business. So it's defensive earnings. I forget what it was called previously, but it was, anyway, it'll come to me later. But KLS is very defensive in its earnings, and it does remain attractive in the current climate and environment. They are and will be able to get or have more organic growth going forward. What I do like about the business is that it does a lot of buses, ferries, those kinds of things. But the higher labour costs is something that they've really struggled with. So they have to sort of look at that. Labour shortages, overtime, casual, those kinds of things have eaten into the margins a bit. There was also the Murray River flooding had impacted a lot of some of their businesses with the Murray Princess business, which will persist into the sort of second half. So that's something that they're. But what a lot of things that I did like about it, they've got 62 zero emission buses out there at the moment, and they're going to do another 61 on order. So that's certainly something good. The outlook remains strong, I guess, for marine and tourism recovery, and further fare increases, which they've now started to put through the business, will help it lift and keeping up with inflation. So it's an interesting business, very defensive. It looks on the charts, it's probably moved a little bit sideways, hasn't really sort of seen that sort of growth. But I think for a client that has a confidence on the tourism side of things, I think they'll do well in this business.
Let's go to Lindsay Australia now, a rural logistics company.
Yeah, so Lindsay, an interesting one, because on the chart alone, it sort of rallied from sort of 75 up to $1, but it's going to do some work around this dollar mark, because basically it's a bit of a headwind, sort of those round numbers in the market. But their outlook comments remain really, really positive. They reported a first half, which was a really good set of results, and I think that's what's helped the stock move higher. But also the CEO, Kim Lindsay, has announced he's going to retire after 20 years leading the company. And again, that's probably going to put a little bit of a slowdown on the business until they find somebody going forward. Never really liked the big transport businesses, one, because they're very capital intensive businesses. For Lindsay, they need to replace their fleet every 5 years, so on a rolling basis every 5 years. And that equates to around about $15 to $17 million a year just to keep the fleet up and running, or keep it going. And certainly, the near-term sort of headwinds on that rural division. Now, remember, there was a logistics business, a fridge logistics business that went down in northern Queensland. Lindsay will probably be the ones to take up a lot of that slack on there. So it's a positive for them as well. So, yeah, I don't mind Lindsay, very thinly traded, so be careful on it. But it will do some work around this dollar mark before it potentially moves higher. But a very good, well-run business on the ASX. Okay,
what about MIN, Mineral Resources?
Yeah, well, MIN gives you that old world and new world look, doesn't it? You know, you've got your iron ore business, which is the old world. You've got the new world, which is lithium. And really, I think overall, We really like the lithium space, and obviously there's some near-term headwinds with lower lithium prices and weaker market sentiment. But Mineral Resources and IGO are our two preferred stocks or two preferred businesses in that space. And Mineral Resources also obviously moves on a little bit of spot iron ore prices as well. So best of both worlds there. Does it continue to get that darling status? I'm not too sure. It looks quite interesting. But yeah, overall, Mineral Resources has been a favourite in our portfolios going forward for clients.
And you mentioned IGO, and I was going to ask you IGO without notice. So you give that company a thumbs up as well?
Yeah, so yes, IGO and Allchem. Remember, Allchem is the merger between Orocobre and Galaxy Resources. So you've got a very large business there. IGO's done some really well on buying some nickel businesses and those kinds of things. So IGO is definitely one of my preferred in the space. Allchem is also, I think you've got to be, there's also value in Liontown, obviously maybe not after the takeover bid that's happened. But yeah, certainly some of the always look and stay in the quality end of that and staying out of the sort of the speculative end of the market. But IGO definitely is one of our major picks in that lithium space.
All right, what about Pilbara?
Yes and no. A lot of people love it. There's a lot of brokers that have got sells on it, on PLS. So just be a little bit cautious. It does command a higher premium than a lot of other businesses out there. And I'm always very cautious with other people's money. So PLS is something that I'd probably have a hold on. I wouldn't be going too hard into that one. Remember, most of these businesses can produce a ton of lithium for around about $5,000 a ton. Now, in the spot market, it's about $40,000 a ton at the moment, and it's been as high as $86,000, right? So there is a lot of talk about the lithium price coming back down to around $25,000 to $30,000 a ton. But even at that, if you got 5,000, you're still making some good money for a lot of these businesses. So just be a little bit careful on PLS. But I'm comfortable with a lot of other businesses in the lithium space. Okay,
one last one. This is the BHP rejection business, South 32. Yeah. What's your view on South 32?
I think it's one of the cheapest resource businesses in the Australian market, and certainly love South 32 for its diversification of metals that it has. Got lots and lots of different metals in there, but it also has a high exposure to coal. So we like that as well. So yeah, I think South 32 is a buy all day. I'm really comfortable with it. Our analyst has got a buy on it. And so yeah, really comfortable with South 32 to be putting it in the portfolio.
Okay, so everything I've asked you today you've liked, or is there anything that you have liked, but you now think it's gone too far? I'm taking profit. Is there anything like that at this point in time?
So certainly something like a QBE or I was going to say Suncorp, but that has come back. Something like a QBE, I don't know if it keeps that darling market status that it used to have. Now it's fighting back. It needs it. Yeah. So I think something like QBE might have run a little bit in the short term. Computershare looks like it's had a good run and now starting to come back as well. It might have a little bit more to go on the downside there as well. So yeah, there's a couple of those sort of interest rate sensitive stocks that have had a good run as interest rates start to move higher. I think obviously if we can see the top of the hill of interest rates, we're not there yet, but potentially taking a little bit of money off the table on some of those ones and then looking for, another business that potentially might do well. I think that's something that you could look at going forward.
Adam, thanks for joining us.
Thanks, Peter. It's great to be here.
Of course, that was Adam Dawes of Shaw and Partners. And coming up now is the founder of FN Arena, Rudi Filapek-Vandyck. Well, joining me now is the inimitable Rudi Filapek-Vandyck from FN Arena. Rudi, great to see you.
Peter, what can I say? I'm here.
Okay.
And happy to be here.
I don't ever use the word inimitable, which is not an easy word to say.
I know.
I'm in your company. I'm in your company. I think, look, Rudi, before we actually go and talk about, some of the observations you're making, where did the idea for FN Arena come from? And how long ago did you put the whole thing together?
The idea came from when I came over from Europe. I'd spent half a decade building up a online news service in the Netherlands. And one of the things we did, and we learned what was very influential in equity markets and very, very highly valued by professional investors, was the upgrades and downgrades that were issued by stockbrokers. So when I came to Australia, to my surprise, nobody was doing it here. Nobody was paying any attention, including the international news services like Dow Jones and Reuters. And I thought, well, that's an easy window to walk through. So we started doing it in Australia, and that is 21 or 22 years ago.
Yeah, great stuff. Well, people who listen to me know I do value the insights that you share with us from that great website of yours. Now, mate, look, at the beginning of the week, when I was interviewed on Sky News, I said the big watch for the week was, though data is important, like our monthly inflation number and the retail numbers, which I kind of think gives the Reserve Bank a chance to pause on interest rates. It'd be interesting to see what they do on Tuesday. But I thought the big issue was, can the black cloud hanging over the banking system dissipate over the week? And I think you've seen stories, I've seen stories that seems to be the market's belief at this point in time. You and I have been around a long time, and we've seen lots of false dawns, and you're a little bit more negative than I am historically. What are you thinking about the black cloud dissipation?
Conservative, Peter, and cautious. That's not the same as negative.
Good point.
I mean, I think what the market is doing is basically responding to the absence of further bad news.
Yeah.
And also the other element is that in anticipation of central banks potentially pausing, if not at the very least moving closer to the end of their tightening cycle, the market is taking that as a positive as well. There are howevers in both cases. I personally, from the information I'm gathering, is that this banking story is far from over, in particular in the United States. However, similar to tightening by central bankers, the effects, apart from the occasional bank tripping over, which we've seen now, the other effects, assuming no more banks trip over in the short term, they take longer to materialize. And I mean, markets are not that patient. They're not going to sit around and just wait for those things to happen. They'll wait for more events to come. And in the absence of that, they can rally because share prices are lower. The other element about central bankers tightening, if markets are still focused on that and investors are still taking guidance on that, I think they shouldn't anymore. I think at this point in time, that's more of an effect that is losing its potence, basically, because I'm firmly of the belief that irrespective of central bankers further tightening, the bond yields have peaked, and they already have come down from their peaks, and history suggests that bond yields always move higher, and they peak well before central bankers pause or stop tightening. And I think that's already, and that's logical, because the one element that is irrefutable here is that any problems in banks, and we have some problems in US regional banks now, they further increase the chances that we will have a recession in the United States, maybe in the second half of this year, maybe early next year. And if all else being equal, markets should be more defensive, more conservative, more cautious here. For the time being, they're not. The other element that is worth pointing out, I think, and is equally important, is that forecasts for corporate profits in Australia continue to fall, and forecasts for corporate profits in the United States, they are still falling as well. And they both have now been falling for quite a long while. The US reporting season, quarterlies, is upcoming. That's about, I think, 2 or 3 weeks away.
Yeah.
That's going to be very interesting, because what we will need to see is yes, maybe at some point we will need to see economic data really forming a bottom, but we have to see also a trough in forecasts for profits, basically, and for margins. So far, we haven't seen that. And I think until we see that, the markets can't really with any confidence say that markets have bottomed before that actually happens. And I know there's a lot of people talking about the new bear market has started, the new bull market has started, and I'm still waiting for more confirmation of that. And a bottom in forecasts for profits could be a very important indicator here, but there are still worries that the upcoming reporting season in the US will actually push down forecasts even further. Yeah. Admittedly, it means we get closer to the bottom, but maybe we have to see some falls first.
Really, I've done a quick calculation, and I think we've been doing this kind of thing probably since about 2008. I think I started on the Sky Business program in about 2007, but it was in 2008 after the GFC that I started working 4 nights a week, and so I needed people like you to help me fill that program. So let's say 2008, and it's now 2023. So we've been doing this, well, how many years is that, mate? That's
14.
Yeah. So
but I actually think if I again may correct you, according to my memory, I came for the first time on your program in January 2009.
Yeah.
And you asked me to whether I would ring the bell for the end of the bear market.
Yeah.
And I said, I'm not going anywhere near that bell. and it still took another 2.5 months, approximately 2 months before, and it was wild in those days, but it did go further down.
Yeah, but really, you know, I'm always championing at the bit to ring the bell on the start of a bull market. Now, the reason why I asked that question is, so we will say 2009, so therefore that means it's, what's 9 take away 23, that's 14. So 14 years, it's probably the 15th time I've asked you, so is this a sell in May and go away?
So that's an interesting one.
Buy in May and stay.
In some years, well, in most years, it actually the weaker period actually follows from late April, late May onwards, around that time, and then we pick up again after August, September.
Yeah.
But that is not always the case, of course. And in years where the months leading into May have been rather weak, and this year is one of those years. That doesn't, by definition, mean, it usually means then that the period between May and September is not that weak as it traditionally is.
Yeah.
And that might be also one of the positives that investors might take away from this, because of course, so far markets, I mean, they've gone up, they've gone down, but essentially they haven't gone anywhere now for a few months. And you see that at the very least at the index level. But if I sometimes look at the stocks I'm watching or I'm owning, the majority hasn't moved. I mean, they're at the same prices where they were in December or in January.
Okay, so let's take advice from someone who's smarter than you and me. That's Warren Buffett. Should we be greedy when others are fearful right now?
Yes, but I'm not so sure whether others are fearful, because they're buying the share market now and it's going up.
Okay. So let me actually move you on to an interesting company, which, you know, your website. I was actually teased by one of my subscribers to the Boom Doom Zoom show yesterday, and they said, "Peter, do you still like Megaport?" And I said, "Well, put it this way. I don't think it's going to get to $20 odd anytime soon, but at $4.15, looking at the wonderful FN Arena website, all analysts like it. All analysts see a big rise, and one has over 200% rise." And I said, well, even if they're only 10% right, that's 20% where I come from. And of course, Bevan Slattery has come back to the company. What do you think about Megaport, mate? Yeah, as a speculative player, we're not trying to recommend it, but I still think as a speculative play, it's a pretty good company that would be a beneficiary when US tech stocks are really, really loved. Is there any fault or flaw in my thinking?
The one flaw short term, well, there's two. One is the company is not profitable. And we can talk about this for a whole year, but at this point in time, the market doesn't like companies that are not profitable and that are not profitable in the foreseeable future. Now, for example, I had a conversation with an investor yesterday that asked me about Ordinate Group, which is one of those other technology stocks.
And both you and I like it as a company.
Yes, I like both of them as well. And but I like Ordinate more, and I see more happening there. And why is that? Because Ordinate Group is not profitable yet, but the market can see that happening. It's on the horizon. It's probably going to happen next year.
Yeah.
And that's a big difference, because seeing that happening, all of a sudden the market gets interested. In the case of Megaport, wonderful positioning globally. It is technology play. It is a play on data centers, but the company has disappointed in a series of events.
At least three times, I would say.
Yes, yeah, exactly. And then the CEO disappeared, and Bevan had to come back and stuff like that. Anyway, the share price is reflecting that. So they have two problems now. There's obviously a little bit upheaval internally, but the growth pace has disappointed, has proven more difficult, and that's probably not gonna become any easier if we do get a recession in the US, or at least a slowdown globally. And there's no horizon for profitability at this point in time. So those are two big disadvantages. Now, I would wager together with you that those two big elements, they're not going to stay forever and ever in place. At some point, management is going to get the act together. The share price looks very cheap here. They will find a way to connect more customers and to get more revenue in, and they will at some point see the pathway to profitability appearing on the horizon. Now, that might still be 2 years away. So the best advice I would say to investors, yes, it's still regarded a relatively high quality company in its local technology sector, but it has now a few barnacles, so to speak, and those will weigh on the share price. So at the moment, it's very highly speculative. It basically moves on sentiment, but that will not be the case forever and ever. I mean,
Okay, good analysis, and I'm with you, mate. Like, my personal exposure to Megaport is actually quite small. I think I probably bought it around $7 or $8 and went to 20 odd, and so I'm thinking to myself, well, it's probably time the dollar cost average and wait. You know, I thought it was a crap company. I had that feeling about Appen. Appen was a great company, but it just seems like the market's turned against it. It's lost a lot of its customers. Yes. And I'm interested in your view on Appen. I just don't think it's going to be an easy turnaround for this company.
No, I agree. I was amazed, as just about everyone else, when the share price surged above $40 back in 2020, I believe it was. I was actually on the register of Appen in those days, but yes, that business model has changed, and here's a lesson also for investors. One is, of course, you can't always trust market sentiment, but I think the most important reason here is sometimes when companies on the stock exchange are listed, and analysts or myself or you, we say, but their client base is so limited. They only have, an Appen, for example, only has 2 or 3 really large customers. Yes, they have more customers, but those 3 customers, they decide that's 80% of revenue at some stage. Yeah. So the risk there is only 1 or 2 of those customers changes their mind or their policy or their strategy or whatever. It has a major impact on a relatively small business as is Appen. I think I'm with you here. I think they will have a very tough task. Industry dynamics are changing. Their customers have become wiser. They don't want they don't want to spend money on Apple if they don't have to, and it has become I mean, to be honest, I'm no longer interested in Apple at this point in time. I think you only have a given amount of money, a given amount of time and interest that you can spend on researching and putting your money in the share market. I think there are much better alternatives out there with much less risk than is now with Apple.
Okay.
I mean, one of the companies, if I could mention one, because we spoke about Megaport earlier, I'm still a shareholder in NextCC. And when the share price last year tanked to a level that I thought it's getting ridiculous now, I bought some extra shares. You know what I mean? And at this point in time, NextCC is looking a lot better than where it was in October, November last year.
Yeah, I love NextDC as well, Rudi, but it seems to me it's nearly becoming like an infrastructure stock, and you just don't expect it to shoot the lights out. It won't disappoint you, and it probably should be in your portfolio, but for people looking for a shoot your lights out type of stock, I just don't think that is like that anymore. If you think I'm wrong, I'm happy for you to say I think you're wrong.
I think the problem with NextCC is they've included it in the old technology index on the ASX, and it shouldn't be there, because I'm with you. It's actually an infrastructure play, like for example APA Group or Transurban. Now, the problem is that people regard it as technology stock. And again, it then on the optics carries the same problem as does Megaport. You know? It's not profitable, and it may not be profitable in the short term. But I think that's the wrong way of looking at it, because once upon a time, Transurban had to make those similar decisions in raising the money first, spending it first on the infrastructure, and subsequently getting into the revenue from the infrastructure. Well, NextCC is not different. I mean, the strong dynamics in the market means that they can continue to invest in new centers. And that, of course, constantly pulls forward new costs and no profits.
Okay, the last question, and this will be the last question, but it's a double barrel question. So it's like this, the penultimate and the ultimate together.
Okay. The answers are maybe and never.
Yeah, come on, have some more guts than that, Rudi. So I'm thinking that even if we get a US recession, by the end of this year, given the history of the third year of a US presidency, given the fact that the fourth year is usually pretty good, I wouldn't be surprised to see a nice rebound of the market. Because even through the recession, we know the stock market jumps in ahead of the reality of the recession disappearing. So, A, do you believe there's a good chance that we will see a nice rebound of the stock market later in the year? And if so, and even if so, and what is the company that you're happy to buy now on the basis that you think by Christmas Day, you'll be popping champagne saying, gee, that Rudi Filapek-Vandyck is a great tipster? Because people watching this show want to know the answers to both those questions.
I know. Well, the first answer, I'm going to disappoint you and some people, because what will make the difference is the timing of that US recession.
Yeah.
And I mean, we're all waiting for it. And I'm giving a presentation this week, and the title of my presentation is, Are We There Yet? Because ever since the Fed started tightening in early 2021, we've all been talking about it, and it's like waiting for Godot. It doesn't seem to be happening, but it most likely will still be ahead of us. But the exact timing of it is always uncertain. When are the data really going to indicate, etc., etc. It may well be that given the glacial pace of what everything is developing, that maybe by the end of the year, we're finally having that recession, and then the market will first go lower, I believe, and then it will become a 2024 story. For your scenario to pan out, we should have that recession actually quite quickly, because then we can get over and done with and move on. Yeah. Getting to your second question, I know that people get tired of me quoting large cap stocks, and in particular the ones I usually refer to. But let's take a small cap company. One that I'm a shareholder, and I do believe that they look very, very good still even after the gains they've made. One is Steadfast Corp.
Yeah.
They are a broker in the insurance policies, essentially.
Good one too. A good one.
And it has performed well since I got on board as well, and it still will perform well, I believe. And the other one is a bit of in a standstill situation here, but I still believe it's equally as attractive as it was 6 months ago. It's IDP Education, and both of them I'm holding in portfolio. And in particular, in IDP's case, because the share market looked a bit weak recently, I was on the verge of buying more shares, and I will if the share price goes lower.
Yeah, great stuff, Rudi. As always, thanks for joining us. And we'll note that it's going to be a bit of a battle, Switzer versus Filapek-Vandyck. It's happened before. When will that recession happen? I'm not sure when it will. You're more certain it's going to be later. But yeah, it's going to be very interesting to see how that plays out. But mate, as always, thanks for joining us.
Thank you, Peter.
And that's the show for tonight. Thanks for joining us. Don't forget, if you want to get more insights, become a subscriber to the Switzer Report. Go to switzerreport.com.au. And many of the analysts that we have on that report don't appear in the TV show. They're exclusively kept for our subscribers. Thanks for joining us. Talk to you on Monday.